How liquidity drives markets more than earnings. When people try to explain why stock prices move, they usually point to earnings, revenue growth, or economic data. While these factors matter in the long run, they often fail to explain what actually drives markets in the short to medium term. Again and again, history shows that liquidity, not earnings, is the dominant force behind market movements. To understand why, we need to look at what liquidity really means and how it influences investor behavior. Liquidity refers to the availability of money and credit in the financial system. When liquidity is abundant, capital is easy to access, borrowing costs are low, and investors are more willing to take risk. When liquidity tightens, money becomes harder to obtain, leverage shrinks, and risk appetite declines. Stock markets are not just reflections of business performance. They are markets for capital. Prices move based on how much money is available and where that money can go. Earnings describe how well a company is performing. Liquidity determines how much investors are willing to pay for that performance. A company can report strong earnings and still see its stock fall if liquidity is being withdrawn from the system. Conversely, stocks can rise even when earnings are weak if liquidity is expanding and investors are searching for returns. This disconnect confuses many investors, but it is a recurring feature of financial markets. One reason liquidity matters so much is valuation. Stock prices are based on discounted future cash flows. When liquidity is plentiful, interest rates tend to be lower and discount rates fall. This increases the present value of future earnings, pushing valuations higher. When liquidity tightens, discount rates rise. Even if earnings stay the same, the value investors assign to those earnings declines. This is why markets can fall without any deterioration in fundamentals. Central banks play a central role in controlling liquidity. Through interest rates, balance sheet policies, and lending facilities, central banks influence how much money flows through the system. When central banks inject liquidity, asset prices often rise. When they withdraw it, markets struggle. This is not a coincidence. It reflects the basic mechanics of capital flows. Liquidity also affects investor psychology. When money is easy, fear diminishes. Investors become more confident, more optimistic, and more willing to pay higher prices for risk assets. This creates momentum and reinforces upward trends. When liquidity tightens, confidence fades. Investors prioritize safety, reduce exposure, and sell risk assets. This creates downward pressure even if company fundamentals remain intact. Markets are emotional as well as analytical, and liquidity amplifies those emotions. Another important factor is leverage. Many investors and institutions rely on borrowed money. Liquidity enables leverage. When liquidity is abundant, leverage expands, magnifying gains. When liquidity contracts, leverage unwinds, accelerating losses. This process can overwhelm earnings news entirely. Forced selling due to margin calls or risk limits has nothing to do with company performance, but it can dominate price action. Liquidity also explains why different asset classes often move together. During periods of abundant liquidity, stocks, real estate, crypto, and other risk assets tend to rise simultaneously. During liquidity contractions, correlations increase and everything seems to fall at once. This is not because all assets suddenly became bad investments. It is because the supply of capital is shrinking. Over longer time horizons, earnings do matter. Liquidity can push prices away from fundamentals, but earnings eventually anchor valuations. However, markets can stay disconnected from fundamentals far longer than many investors expect. Understanding liquidity helps explain why being right on earnings is not always enough to be profitable. In summary, liquidity drives markets more than earnings because it determines how capital flows, how risk is priced, and how investors behave. Earnings tell you what a business is worth. Liquidity tells you what the market is willing to pay. Once you understand this distinction, market movements become far less mysterious.